Ever wondered what makes a stock a great long-term investment? Forget the daily hype and market noise. Today, we're diving deep into the world of fundamental analysis. This is the secret sauce that legendary investors like Warren Buffett use to find incredible companies at fair prices. By the end of this video, you'll know exactly how to look under the hood of a company and decide for yourself if it's a real winner. So, what exactly is fundamental analysis? Simply put, it's about figuring out a company's true intrinsic value by looking at its financial health and business performance. We're not just guessing, we're playing detective, using real data to make informed decisions. It's all about buying a piece of a strong business, not just a lottery ticket. Let's start with the big three financial statements. First up is the balance sheet. Think of this as a snapshot of the company's financial health at a single point in time. It shows what a company owns, which are its assets, what it owes, its liabilities, and the difference between them, which is the shareholders' equity. A healthy company typically has more assets than liabilities and growing equity over time. Next, we have the income statement. This tells you how profitable a company has been over a period, like a quarter or a year. This tells you how profitable a company has been over a period, like a quarter or a year. It starts with revenue, subtracts all the costs and expenses, and ends with the famous bottom line, the net income or profit. This is where you see if the business is actually making money. Is revenue growing? Are profit margins stable or improving? Is revenue growing? Are profit margins stable or improving? These are the key questions the income statement helps you answer. Finally, there's the cash flow statement. This one is super important because cash is the lifeblood of any business. It tracks all the cash coming in and going out. You can have a profitable company on paper that runs out of cash and goes bankrupt. This statement is broken into three parts: cash from operations, investing, and financing. We want to see a company generating positive cash flow from its core business operations year after year. Now, let's talk about some key metrics you'll hear all the time. First is the PE ratio, or price-to-earnings ratio. It's calculated by dividing a company's stock price by its earnings per share. A high PE might suggest a stock is expensive, while a low PE could mean it's a bargain. But be careful. Context is everything. Fast-growing tech companies often have high PE ratios because investors expect high future growth. Fast-growing tech companies often have high PE ratios because investors expect high future growth. You need to compare a company's PE to its own historical average and to its competitors in the same industry. Another crucial metric is earnings per share, or EPS. This is the company's profit divided by the number of outstanding shares. A consistently growing EPS is a fantastic sign. It means the company is becoming more profitable for each share you own. When you see EPs increasing year over year, you know management is doing a great job. Let's put this all into practice with a real-world example. Tesla. Everyone knows Tesla, but how would we analyze it fundamentally? First, we'd look at their income statement. We'd see massive revenue growth over the past few years. They went from losing money to being consistently profitable. That's a huge checkmark. Their earnings per share have also been growing rapidly. Then, we'd check their balance sheet. We'd look at their cash position, their debt levels, and their total assets. We'd look at their cash position, their debt levels, and their total assets. Is their debt manageable compared to their equity? Are they building up a solid cash reserve? For Tesla, managing debt while funding massive growth in factories and R&D is a key part of their story. Finally, we'd analyze their cash flow statement. Is Tesla generating cash from selling cars their core operation? Is Tesla generating cash from selling cars, their core operation, or are they relying on borrowing money or selling new stock to stay afloat? A few years ago, this was a major concern, but now Tesla is generating strong positive cash flow from operations, which is a very healthy sign. But numbers don't tell the whole story. We also need to look at qualitative factors. These are the things you can't easily put on a spreadsheet, but are just as important. For Tesla, this would be their brand strength. Their brand is one of the most recognized in the world. What about their competitive advantage, or moat? Tesla has a huge head start in electric vehicle technology, a global supercharger network, and massive amounts of driving data. These create a powerful moat that makes it hard for competitors to catch up. We also have to consider the management team. Is Elon Musk a visionary leader or a liability? You have to assess the leadership's track record, their vision for the future, and their ability to execute that vision. Finally, what about the industry itself? The shift to electric vehicles is a massive global trend. The shift to electric vehicles is a massive global trend, and Tesla is at the forefront. This provides a powerful tailwind for their business. To give you an even deeper perspective, I spoke with a professional analyst about how they hunt for value in the market. The biggest mistake I see beginners make is falling in love with a story without checking the numbers. A great story needs to be backed by great financials. I always start with the cash flow statement. Does the company generate consistent cash from its operations? That's my first filter. Then I look for a durable competitive advantage. Why will this company still be a leader in 10 or 20 years? I also look for companies with low debt. A business with a lot of debt is fragile. If a recession hits, they can get into serious trouble. If a recession hits, they can get into serious trouble. My advice is to be patient. You don't need to find hundreds of great ideas. Just a few well-analyzed high-quality companies can build incredible wealth over the long term. Do your homework. Trust your analysis and don't let market noise scare you out of a great position. That's some incredible advice. It really reinforces that fundamental analysis is a powerful tool for long-term success. So let's recap. Fundamental analysis helps us understand a company's true worth, separate from its day-to-day stock price swings. We learned to analyze the three key financial statements: the balance sheet for financial health, the income statement for profitability, and the cash flow statement for cash generation. We also covered key metrics like the PE ratio and EPS, which help us quickly assess a company's valuation and profitability. And remember, numbers are only half the picture. We must also analyze qualitative factors like competitive advantages, management quality, and industry trends to get a complete view. By combining all these elements, you can build the confidence to invest for the long term and ignore the short-term market noise. Your turn. I want to know what company you're curious about. I want to know what company you're curious about. Drop a stock ticker in the comments below and let's discuss what a fundamental analysis might look like for it. I'll be down there replying to as many as I can. Thanks so much for watching. If you found this guide helpful, make sure to hit that like button and subscribe for more content to help you become a smarter investor. See you in the next video.